Debbie Marcoux, licensed by the Department of Financial Institutions and MLS ID 237926. Also licensed in Arizona 0941504, Florida LO 76508, Georgia 69178, Idaho, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.
Well, welcome to Mortgage Mom Radio. I'm Debbie Marcoux, and you guys are looking at Carrie Young, right?
Still not officially. I'm actually going to Social Security right after this to change it. Almost there. Almost there.
Many of you guys have worked with her before as Carrie Margulies, and she is one of our loan officers here at Mortgage Mom Radio. But Carrie is going to be on the show today. I'm putting her on the spot so that I didn't have to get myself all done up. But we are going to be talking all about points today. I know that a lot of people have questions all the time. Yes. Should I pay points? Should I not? Why am I being charged points?
What are points?
What are they, right? What are they for? So we're going to be talking about points today because I think that is a very hot topic. I think that there are clients that have paid points that didn't even know that they were paying points. Mm-hmm. They have a very hard time with trying to actually shop a rate and then don't realize that the rate at one lender sounds so great, but then there's points being charged. So I definitely want to get into that today. We want you to know that we want you guys to follow us, do it with us live. So when we go live, we want you guys to jump on with us and be able to ask all of your questions. So you do that by going to YouTube and looking for the Mortgage Mom Radio channel and subscribing. Turn on that notification bell so you do know when we go live, and that way you don't miss any of our shows. But we are on every week, Monday and Wednesday at 1 p.m. Pacific Standard Time. Heidi jumps on right now. She says, hi, ladies. And Heidi, thank you so much. And I just want to remind you guys that we're here for your questions. We're here to help you. You can go to our website, go to mortgagemomradio.com and book your free phone consultation. You'll be talking with one of the girls. You guys met Heather last week on the show. This week we've got Carrie on. Next week is going to be Cindy. The week after that, hold your breath, Heidi, you're on. So we want you guys to get to know the team. We want you to be comfortable with that. And that's why we're also doing our Spotlight series on Friday. So your Spotlight was a couple weeks ago. Yep. So if you guys want to learn more about Carrie, you can find her video, her Spotlight video in our folder. I was trying to find the word, but it's our folder on YouTube, and it says Mom TV. So you can find her interview in our Mom TV folder, our playlist. There you go, playlist, our playlist on YouTube. All right, so let's jump in, though. If you guys want to give us a call, we're here. It's 844-935-3634. Heather jumps on, says, hi, ladies. And Heidi jumps on and says, what? LOL. Just kidding. My Aunt Lori jumped on. She says, hi. So, hey, Aunt Lori, thank you for watching. Haven't seen you on in a while. But let's jump right into it. I want you guys to call us. Do you know our number?
It's 844-935-3634.
That's right. It's 844 We Lend for You. That's WELEND and the number 4. So we're going to jump into points, and I'm going to let you get started. And then I'm going to ask you questions when things come up that I think that someone listening might be thinking. So I'm going to kind of pretend to be the consumer.
Perfect.
Yeah. Good.
Okay.
All right.
So mortgage points, also known as discount points, are used to basically buy down your interest rate. Sometimes it makes sense. Sometimes it doesn't. It just depends on the person's personal situation, the loan type, how long you plan on keeping the loan, things like that. One of the things you really want to look at, whether or not you should or shouldn't pay points, is the recoup on the savings. So for instance, if you have a loan amount of and I guess I should explain that a point is 1% of your loan amount.
There you go. So if you have a loan amount, like you were going to say, of $400,000, let's throw that number out there. You got a loan amount of $400,000. 1 point is 1%, which is $4,000.
Correct.
And points could be 1 1/4, 2 points, 2.5 points, 3 points. It could be a 1/4 point. It could be any percentage number. Correct. But it is basically the percentage of the loan balance.
Yes. And just to give an example, if you're have a loan amount of $400,000, you pay a point, it will buy down your rate typically a point brings your rate down about a quarter. And mostly a quarter is what I see. So say the savings on your monthly payment is $50. You spend $4,000, you save $50 a month. So 50 divided by 4,000, it comes to about 80. So divided by 12, 'cause it's 80 months, you're looking at about 6.6 years.
Right.
So if you're going to keep that loan 7 years, 10 years, it might make sense to you. But if you plan on selling, refinancing, doing anything else in 3 years, it doesn't really make sense.
Well, and that's actually a good point, because I have a lot of clients that do want to buy the rate down, and they get really excited about bringing that interest rate lower than what the current market is. In their mind, they think, it's really good, because if I can get a lower rate than what the actual market rate is, then even if interest rates were to drop later down the road, I wouldn't feel like I had to refinance and pay refinance fees again, and it would bring my payment down to where I want it to be. And then I stop them and I say, wait a minute though, we have to consider, might you possibly refinance again? Are you going to be calling me in another year and a half and telling me you ran up those credit cards and we need to get them paid off, or you need to buy a car for your child, or now all of a sudden there's medical expenses, or your roof needs to be replaced, or something that's happening. Now we want to remodel our kitchen. And that's another big one too, is that I have people that want to remodel the kitchen, and I'm like, okay, but once you start the kitchen, you're going to want to do more than that. It's going to bleed into the rest of the house. And sometimes we'll end up doing one refinance and then another refinance, right? Instead of having just did one or done one. So it is really, really important, like you said, for them to figure out how long are they truly going to keep that loan for.
Right.
Makes such a big difference.
Yeah.
And whether they should or should not pay those points.
Correct.
So there are times though that I have seen, and I want you to kind of explain a little bit, but there's sometimes that we see that there isn't an option but to pay points.
There isn't. There's certain loan programs, typically your non-QM products, your bank statement loans, your investment loans, asset depletion, things like that, where you have to pay points. It's kind of a hard money loan. It's not quite as bad as a hard money loan, but it's not your conventional loan where you can get par pricing or no point pricing. So even though like a hard money, you'd be paying 5-10 points, with these, you're paying anywhere from 2 to 3 points, maybe more depending on where you want your rate at. But typically with our non-QM loans, you're paying about 2.2 points.
Yeah. And the best way for people to understand what a non-QM loan is would be, if you go back, a lot of people used to refer to them as subprime loans. They got a new name put on them once we had CFPB come in and kind of start making corrections and changes to the lending industry after the whole huge meltdown in 07 and 06. And
it sounds nicer than subprime.
It does. It definitely sounds nicer to say non-QM. And what does non-QM stand for, right? So QM means a qualified mortgage. That means that you're qualifying for that mortgage with the normal standard W-2s and pay stubs,
tax returns.
Exactly. And a non-QM or a non-qualified mortgage would be somebody that's doing it in alternative financing. So you might hear subprime, alternative, non-QM. It all means the same thing. But in those programs, because they are more risky, there's more risk to them, those lenders are going to want to get paid a little bit of extra, and they're going to charge you points up front. Now, the other time that I'll see that happen is even on the qualified mortgages, our standard Fannie, Freddie conventional mortgages, is when somebody is buying an investment property.
Right.
So there are going to be adjustments to the rates, and you know this, so I'll let you kind of explain the adjusters and how those work.
Right. So on an investment property, you're going to get better pricing the more money you put down. The minimum down payment is 20%, but the rates and the points are a lot higher when you just do the minimum 20%. So if you can put 25, 30% down, you can probably find yourself a rate without points.
Right. And the way that the rates, the way that we get to a rate, so think of it this way, is if you have a standard owner-occupied, single-family residence, 30-year fixed, and again, interest rates, we've talked about this 100 times. What makes your rate? Why don't we come out and say, everybody call right now. Rate is 2.99 for this weekend. Get it within the next 30 seconds and call us. Well, we don't do that because it's not true, right? It's all about the client, their credit score, the equity in their home, whether it's a refinance or a down payment. It's about their credit score, whether
Property type.
Yep, property type, whether it's a single family condo, whether they're impounding, are they, going to have their taxes and their insurance as part of their payment, or are they not, right? All of these things factor in, and they're called adjusters. If you're a condo, you're more risky than if you're a single family. And people say, why? Why is that? And my favorite one is, but mine's a townhome.
Yeah.
It's not a condo. So bottom line is are you attached, right? An attached property is going to have more risk than a single family. Why is that? Just over the course of history, it has been found that when markets tank or they dump and people are going through hard times and we have recessions, that more people will walk away from a condominium than they will from their single family home. So there is going to be more risk based on that type of property. So there's adjusters. Well, there's also adjusters for occupancy. So you have second home adjusters, you have investment adjusters. So like Carrie said, with the down payment, if you have the minimum down payment that you can get and you're an investor, these are all adjusters. Let's say you're buying a condo, you're an investment with only 20% down. These are adjuster. And sometimes the rate sheet won't give us an interest rate high enough to cover all of the adjustments, which means that we have to charge the points. We don't have a choice.
Correct.
Right? So I've also seen it though with owner occupied. So a lot of times where is it that you're running a rate sheet? Somebody calls you and says, okay, Carrie, can you quote me a rate? I want to,
On an owner occupied that I've seen recently where you have to pay points is cash out and really low FICO score.
That's exactly where I was going. So many times, even if you have the equity and if your credit score is low and you're taking cash out, we've found that an FHA loan a lot of times will actually be a better fit than a conventional loan. So we're going to talk to you and work with you through all of the different types of programs that are going to work for your scenario and then determine what's the best option. So if I was calling you and I said, Carrie, I've got a 600 credit score, but I need to pull cash out. I've got all this debt and I got to get rid of it. Plus I really wanted to get like 20,000 out. I need to redo the roof. What would you recommend? What would be your game plan for me being on, it's our phone consultation, right? I'm calling you up and I'm going, I need help, mortgage mom. What would be your suggestion in that situation?
My suggestion would be FHA, cash out, get money, pay off all your debt, clean up your credit, keep the loan. You don't want to keep the FHA if you have the equity in the property because it has the mortgage insurance for life. So do the refinance, get your cash, pay off your debt. Most of the time, people's credit score is so low because they have so much debt or they're maxed out on their cards. So pay off that debt, bring your credit score, get it up to 600. Then we can refinance again in 6-7 months to a conventional, save you even more money.
Right. So, and I would say that as well. I mean, it's, if and many times, if somebody owns a home, they have equity in the property and they're calling us and their credit scores are low. Like you said, many times it's because they just have, they're almost maxed out on every debt that they have. Every credit card's maxed out. They've got the cars financed. They got the student loans going on,
right?
And they're struggling, but they're doing it, right? They're working hard. They're paying their bills. It's just, they're low because of where they're at and they just need a little bit of relief. And as soon as they pay those credit cards off and we open up those credit limits, we'll see their credit scores shoot up 60, 70, 80 points, fast, right?
Yeah.
And so it's one of those things where we could, you definitely want to get the mortgage on there. You want to make a couple of payments on that mortgage. You want to get those credit cards all paid off and everything updated. You don't want to go out and reuse those credit cards.
No.
But then we could then turn around and, like you said, put them in the conventional, get rid of the mortgage insurance, drop the interest rate, get it down lower because they're now a different borrower. They're not cash out. Mm-hmm. They have a higher credit score, right? And maybe with FHA, we don't have to charge those points because the loan is so risky.
Right.
With conventional, where we wouldn't have a rate to give you at zero.
Right.
Right.
Yeah. And I have done this scenario where the client says, yeah, but my payment is going up $1,000, and I have to explain to them that, yeah, but you're paying off all this debt. So you're actually saving $2,200 a month on payments you no longer have. So even though your mortgage goes up, you're really saving overall $1,200.
Yeah.
So
Yeah, no, and it's big, and a lot of times the clients can't quite grasp that unless they are doing the phone consultation with us, and
Right.
it really does help. I don't know about you, but I can tell you that it is significantly a better conversation that I have with a client when they actually pull together all of their debts, have their statements, know how much they owe, know what the minimum monthly payments are, and they can see the interest rate sitting on that statement for that debt that they have. So we've got all the buy now, pay laters that people do own from, or they owe from the holidays, right? And the Pelotons and
yeah, and I'm seeing a lot of the ACEMA.
uh-huh.
I think that's another buy now, pay later sort of thing.
Yep, where it's a monthly payment until it's paid off.
Yeah.
So, we're seeing a lot of that. Plus the credit cards are maxed out. Plus they've got the student loans, and plus sometimes they've got the car payments. And, sometimes they're, a lot of people don't want to put a car loan into their mortgage if they don't have to, because it's a shorter term, 5-year loan or 4 years that's left on it. And so they don't want to then take the mortgage or take that debt and finance it over 30 years. But sometimes, we just got to get them back under control and get them comfortable and back into a cash flow situation where there's not struggling, right?
Right.
So it just depends. But to get the free consultation, you guys got to call us. You want to talk to Carrie. Are you on call this weekend? Is it you?
No,
No?
not this weekend.
All right.
I did 2 in a row.
You did 2 in a row. That's okay. But if you guys want to talk to Carrie, you guys can call. You can ask for her specifically. Give us a call at the office. Give them the number.
It's 844-935-3634.
Yes. And if you guys want to know more about points, get on the calendar. Go to mortgagemomradio.com. Book that appointment. There are girls on call. I think it's actually Heather coming up this weekend, but she'll be on call. She can take your calls if it's Saturday or Sunday. You guys want to talk to Carrie directly, you can call and ask for her and get booked with her. You can leave a message with the call service. They'll actually text us and say, looking for Carrie. So if you want to speak with Carrie directly, you can. But again, give them the number one more time.
844-935-3634.
Thank you so much for being on, Carrie. You
Thank
did
you.
Great. How
Thanks.
did you feel being the only person in the...
Still kind of nervous.
Yeah. You did great. Don't
you.
worry whatsoever. Everybody listening, remember we're on YouTube every Monday and Wednesday at 1 p.m. Pacific time. We want you guys to join in and ask your questions while we're doing it live. I'll be back this Wednesday, 1 o'clock. And if you guys are listening by radio on Saturday or Sunday and we sound pre-recorded, well, that's because we are. If you guys want to get in and be part of the action while we're doing it live, you got to watch us do it. So go to Mortgage Mom Radio on YouTube, subscribe to that channel, click that notification bell so that you know when we went live. If you guys are watching the show and you guys enjoy it right now, please give us a thumbs up. That is amazing for the algorithm. And we'll be back next Wednesday or this Wednesday.
Yeah.
Yeah. Talk to y'all real soon.
Bye.
Debbie Marcoux, licensed by the Department of Financial Institutions and MLS ID 237926. Also licensed in Arizona 0941504, Florida LO 76508, Georgia 69178, Idaho, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's a mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.